Hello, everyone. So, welcome to a live market update with Buying South Florida. We have a lot to talk about today. We're going to talk about inflation and our thoughts on how that's going to affect the real estate market going forward. We're going to talk about interest rates, what has happened to the interest rate market, not only the federal funds rate, but also the mortgage rates. And we're also going to talk about some planning on how current homeowners and current tenants should prepare going forward. So today we have Dominic with us. So Dominic, tell us a little bit about what your thoughts are, what's happening in the market, and what we need to do to get ready.
Yeah, man. Basically on Friday, if you guys have been tuning in and just which I'm sure a lot of people have been, they've been seeing the reports, they've been seeing the articles coming along with the CPI index, the CPI reading on Friday. It surged to about an 8.6, so almost a 9% year over year, and that is a new almost four decade year high. So I wanted to ask you, with that reading, man, how exactly will that impact us in the housing market?
So, I mean, it's a long answer, right? So you have with inflation, inflation really affects the long-term fixed mortgage rates. Right? You got to remember that whenever you're locking in an interest rate for 30 years, as time passes, that debt, that investment for the bank has or diminishes over time. So it becomes less valuable to banks. So if banks continue or would have continued to keep the interest rates at 3% like they were before, but inflation is at 9, 10%, they're losing that spread, right?
Yeah.
So as time passes, that debt becomes significantly lower in value to them. So naturally, as interest rates as the inflation rate continues to go up, the banks have to adjust their long-term fixed interest rates to change along with those inflation rates. And again, historically speaking, the inflation rates tend to follow, or the 10-year bond tend to follow the inflation rate, and the mortgage rates. I'm sure you've heard this. It follows a 10-year Treasury bond, but it's not the Treasury bond that it's following. It's really following inflation. And the 10-year bond just happens to be an adjustment to inflation, so they parallel each other, right? So again, as time passes, the value of those debts to the banks just diminishes over time. And I think it's going, as inflation just remains high, the rates are going to continue to go up. There's no other mathematical solution for it. It's just what it is.
Yeah. So Jerome Powell, the chairman, he's looking into. Well, they have been at these meetings that they've been doing that have been taking place. He's been increasing the central bank rates by about 50 basis points, and it just came out where it just dropped that a lot of investors are now rumoring that it's going to go up to about 75 basis point increase here on tomorrow's meeting. So with that, obviously they're trying to combat inflation. They're trying to pretty much level the amount of people borrowing money. So what do you feel like that can do there with a 75 basis point increase? How can that help us? How can that help inflation? How can that help combat it?
So that federal funds rate essentially is there to combat the inflation rate. If inflation is at 9%, but the Fed's fund rate is at 3%, it's not going to slow down inflation.
Correct.
So with that being said, I think it's only going to continue to get higher as inflation either maintains at 10, 9, 10%. That federal funds rate is just going to continue to go up because they're trying to withdraw or take money away from the market. Inflation was created or has been created because we flushed the market with so much money through COVID, right? And then what happens is the only way to take it away is now with monetary tightening, which is the Federal Reserve buying back some of that money through bond sales and things like that, some of their assets, but then also discouraging the consumer from borrowing more money. So it takes away from the money supply, and because you take away from the money supply, that in turn turns to lower inflation. So I think increasing the federal funds rate is a must do, and it has to be done to be able to combat the inflation rate. And I honestly think that inflation is much higher than 9, 10%. I think inflation is, well over 15, even 20%. If we look at some things like gas prices and food, for example. So I think that as inflation continues to maintain or increase, the Federal Reserve will continue to increase the Fed fund rate to try to diminish the money supply and get inflation under control. So I think that in summary, or in layman's terms, what happens is we have to discourage, or we have to minimize the money supply. So we have to discourage borrowing, and we do that by increasing the interest rate. I think it's the right move. I don't think it's something that's wrong by the Federal Reserve. I think what the Federal Reserve is reacting to some of the policies or some of the actions that the government took through COVID, which essentially flushed the market with so much money.
And when you say so much money, you're pretty much referring to the stimulus checks that were given out. I want to say it was I want to say rough estimate 1.7 to 1.9 trillion, I think, in stimulus dollars.
Yeah.
So that had the negative impact, which now is causing this pretty much reaction of the market, and everybody kind of, oh, there's a recession coming, this and that. All these alarms are getting pulled. So what you're saying is this is a healthy correction. Like, this is something that is definitely needed for our market.
Well, I don't know about healthy correction, but it is needed.
Yes.
And it's needed because inflation was created by things like stimulus checks. If you remember early on in the pandemic, once they shut everything down, they started giving away commercial loans, business loans, without the requirement of those loans to be repaid. And they flushed the market. The government flushed the market with trillions of money, trillions of dollars in money. So what happened is, if you create or just created so much money out of thin air, but no products or services were rendered in exchange for that money, so all you did was increase the money supply. So that created all of the inflation. Now think about all of the states and all of the businesses that forced those the states that forced those businesses to close, and they had to take the stimulus checks. Otherwise, they would have been either bankrupt or shut down. So
Yeah.
It's not so much of it's not a one factor that caused all of it. I think it was many different decisions, not to say right or wrong, just saying this is what happened. The money supply was increased a lot through COVID because of the stimulus, and ultimately we are now paying the price. So the Federal Reserve has to increase the interest rates. Otherwise, inflation would just go 20, 30, 40%. And in the long run, that is how currencies just depreciate. And you have places like Venezuela and other countries that you have $1 million, for example, and it doesn't buy you a pack of cookies.
Yeah.
Right. So
I mean, with raising the rates aggressively, like how they have been and will be for some time now, the risk obviously comes out to recession. So everybody, that's been the big topic as well. Are we entering into a recession? Is there going to be a definitive recession next year? It's hard for people to say. I mean, you can read data, you can read charts from previous years, but I mean, it's a good way to tame inflation. But what are your thoughts on how that can affect us in the housing market? How can that affect rates and how housing prices?
And I think as things continue to get more expensive, the tenants will be the ones that pay for it. So as a real estate investor, if property insurance goes up, if the cost of repairs, maintenance in the property goes up, if the cost of your HOAs, your taxes, everything goes up, then the only option that you'd have is just pass on those costs to the tenants. Because if someone has 10, 15 investment properties, it's very difficult to just take a loss on all of it. If someone has 1 or 2 investment properties and they're living paycheck to paycheck, they can't afford to take a loss on those properties just to keep a tenant happy. So what's happening with the inflation, it's going to really affect the rental market. And for anyone that thinks that the property values are going to decrease going forward, right? So let's think about that for a little bit. If the prices now begin to decrease, interest rates rise, mortgage interest rates rise, the property values decrease, less people will go out to buy, right? Because of fear that markets can crash, markets going down, so I won't buy. That mindset creates more demand for tenants because there's less buyers now, so there's more tenants. So having more tenants is going to create more competition in the rental market, and more competition just drives the prices of tenancy up. So for anyone that's out there that's a tenant that thinks, hey, I'm just gonna wait till the market crashes or goes down, I mean, the rents is just going to go up. So that's one possible scenario that could happen. As less people enter the market to buy, more people become tenants, and ultimately drives the prices of rentals up, right? So I think that's one outcome. Again, no one really knows what's going to happen, but that's definitely a very, very possible outcome going forward. If now the mortgage rates have risen to almost 6%, in some cases even over 6%, it stands to reason that property values are going to adjust down, because just so that the same buyer, the same prospective buyer was pre-qualified at 500,000, let's say, but at a 5% interest rate, if you now increase it to 6%, that same buyer at 500,000 qualifies for 450. So what could end up happening is the sellers have to adjust their property values or their sales price down to be able to sell to that buyer at 450, right? And that'll essentially happen in all price ranges. But the first time home buyer, second time home buyer price range, I think will suffer the most because of that. The luxury market is a little bit different, and it always has had a little bit of a slower turn time when it comes to adjusting to market volatility. But still, it's not, it's going to happen there too. If you have interest rates on jumbo loans going from 5% to 6% on a $2 million loan, that's a big adjustment on your payment. So many times once the interest rates increase, you'll just see those property values come down. Now, what saves us, in my opinion, is that there's so much demand to buy. So as long as demand just stays up, I don't think the property values they're definitely not going to crash, but they may sustain or plateau going forward. Maybe not increase at the same rate. I don't think that's going to happen, the same rates that they've been increasing before, but I definitely think that at the very least, the demand will in some way offset the rise of interest rates.
Yeah, and I was going to say too, because reports are stating that April and May had significantly pretty stable, showed stable percentages in demand for people still looking to purchase properties, and they were, showings were up. So I think with the recession talks, obviously there are usually like 5 key factors you want to follow for a recession, and obviously one of them being housing prices going down and consumer confidence dropping. So I mean, in a market like this, it's like you stated, it's hard to tell. It's really hard to tell, and a lot of people are unfortunately starting to get worried, which is normal. But I mean, in the housing industry itself, you're stating that it's not alarming just yet. Like there's still some hope.
It really depends on the person. It depends on the goals. It depends on the scenarios. I'm very hesitant to give like a vague blanket solution to everything. There's people out there that just say, don't buy a property. I think whoever is advising that without really knowing the goals or specific situations of someone, I think is irresponsible to do so. So whether we think you should buy or not going forward really depends on the person. I think it's more like, if we have the conversation about what could happen going forward from our experience in the market, and then ultimately letting the tenants or the buyers decide whether it's a good time for them to buy or not, is the best approach.
Yeah.
So I think that going forward, because if market values decrease and that diminishes the amount of buyers in the market, that means more people will rent, and the demand for rent will go up, which now means there's more demand for rent, higher prices. So if someone's holding out for the market to crash, they may end up paying significantly more rent in the next year or two, waiting for a market crash that just may never happen.
Yeah.
And if they're waiting for a correction of what exactly? Is it 10%? And how quickly will it get there? And many times what I found is that as people wait for that correction or that market crash, once it starts correcting, now they get afraid to buy because the prices are too low. So what ends up happening is they just never buy, right? Because they're listening to their neighbor, who already owns 3 or 4 properties, and they're telling them don't buy now, or they're listening to the news and they're saying it's a market crash, when in reality there's no market crash. It's just a correction of values, right? So I think every person needs to really determine what their goals are, medium to long term, whether it makes sense for them to buy a property and hold it long term, whether it makes sense for them, to continue to rent, maybe buy in a year, maybe buy in a few months. It's up to that person, but it depends on the goals, medium to long term, right? It's always very important to understand what someone is trying to achieve with the purchase, right? If someone wants to buy a property to flip, what do you think about flipping properties now in this market?
Flipping properties?
Yeah.
I mean, that's the thing. I really can't touch on the flipping property subject. I think, like you said, being situational, you really just want to see and you want to take it by. If someone was to come to your desk and say, hey, I want to flip this property right now, what should I do? You really just have to assess their situation. And I mean, like you were saying, to kind of go back to the renters thing, I think that's one of the biggest things, not to speak for you, but that we preach is you don't want to get caught on the sideline, like we usually say. You really, if you're renting, you don't want to wait for a market crash or for the housing bubble or to pop or anything like that. You really just want to look into it now. If you have the finances and credit and you're financially set and you feel like you are, to come talk to us, because you're leaving money out on the sideline, not only on the sideline, but you're just not burning it, but you're wasting away what could be an investment into your own asset. And I was just reading an article the other day that I think it was 11 years in a row that real estate was labeled as the best long-term investment. And I think that speaks volumes in itself. So if you are renting and you really just go about, I'm waiting for the next market crash. And I know a lot of Gen Z millennials tend to believe the same. Oh, when is it going to crash? When is it going to pop, do something? I just want to see it. But in reality, now is the perfect time to buy more than ever.
Hey, are we back? Mic check, mic check. So what I was saying is, ultimately, if you have someone that just sitting on the sideline continues to just wait for that perfect time, may never come. This may be the same person that early 2019, early 2020 was waiting for the market to, I don't know, go up, go down. The market reacts to COVID, and now they just find another reason to not buy. And then the interest rates are 2-3%. I kept preaching to everyone, there will never be rates like this again. You're locking in today's rates, and as inflation continues to go up, that debt just becomes significantly more. It diminishes over time. It becomes more or easier to pay over time just because of inflation. So what ends up happening is anyone that's looking for an excuse to not buy now will find it. And there's plenty of YouTube channels, there's plenty of news that will tell you just don't buy something. Just don't buy, it's not the right time. And if you're looking for reasons to buy, you'll find reasons to buy now too. So ultimately it just depends on the person, right? And to your point about the whether it's a good time to buy or not, think about everyone that has been waiting for a market crash these past 2 years. all of the equity and gains they could have had in their property over the last 2 years, waiting for the market crash.
Yeah.
And before that, I heard it all the time, the market's going to crash. And the same people just create or find ways to talk themselves into not buying. A better approach, in my opinion, is if you were to have, instead of trying to time the market on a absolute crash or anything like that, it's better to create a plan, medium to long term, and say, I'm gonna buy X amount of properties over the next 5 years, 10 years. I'm gonna buy this property. In 3 years, I'm gonna buy another one. In another 3 years, I'm gonna buy another one. Keep these to rent. For example, for that example, it doesn't matter what the market does now. You'd buy a property at 600,000 today. If you're going to live there, if the goal for this person is to live there for the next, for foreseeable future, 10 years, then it doesn't matter if the market crashes in a year or two. History tells us that the market values will come back up anyways, right? So as long as somebody's not selling that property, you're not at a loss. However, if you continue to rent and you're just waiting for that market crash and you really look into how much money you're going to spend on rent over the next 2 or 3 years, just waiting for a market crash, and then you buy something, you have to account for all of that money you just threw away in rent. As opposed to if you would have bought now, saved up for 3 years, all that money that you would have spent on rent or anything else, now you can buy again if the market crashes in 3 years or in 2 years because you're ready to buy again. And this house, it really doesn't matter if the market value goes up or down, you're keeping it. It doesn't matter, right? As long as it rents and it produces some kind of inflow, you're fine. Now, what I don't think should be happening now for buyers is someone that's looking for a short-term investment or like a flip, like I mentioned before. The reason is you usually want to flip on a market that's going up rapidly. You don't want to flip at the very top or the very bottom of any market because there's not enough margins. So you'll have the same amount of risk whether you flip at the top or the bottom. You'll risk, whatever amount of money into the property, and then what happens if the market just completely drops and you're upside down because you're trying to sell it? That really matters. You won't get your money back. But if someone that just buys it with the intention of keeping the property long term, it really doesn't matter what the market does in the short term. You're gonna keep it. You're going to live there or rent it later. So with that, I do hear a lot of pushback when it comes to market fears and things like that. What are some of the fears that you guys are hearing now? Some of the pushback that you're getting from either your friends, some of your clients, and so forth, as to what's happening in the market.
Yeah, I think before it became apparent that rent was, the rise of rent was so extreme, there's been reports out and a lot of people have come out and said this is absurd. You haven't really heard that before, but I'd say probably about a year ago today, a lot of my friends, when I've been, when I was in the industry and I was trying to talk to a lot of them to try to get them pre-qualified, and a lot of my friends are ready to move out, and they always talk about, oh, but I'm just gonna wait for the crash. I'm gonna wait for the next crash. Dude, renting is way cheaper. And I was like, it clearly isn't. I mean, if you can, depending on situations, because we what you said, you want it, it's all situational. However, it really, you're spending all of this money on rent, like you stated, to where you could be putting it all into an asset such as a house. And if it's, a lot of them just kind of didn't see that. And I think a lot of them still feel as if rent is still cheaper than owning a home. But I think that also has to, kind of just go to the first home buyer jitters, I don't know if you experienced it. I mean, I work in the industry and I still, get them at times, but I am ready to look for the properties and, just kind of waiting for a few things on my end to come about to where I'm stable enough to move into a property. But I think it just goes to show that, a lot of first time home buyers are kind of on the fence, whether they're living with their parents rent free or whether they are renting, they want to save up as much money as possible. That's one of them, and then of course, like you stated, a lot of them say, I want the market to crash. I'm gonna wait for the next market crash, and then it's like, okay, and then you can see if a crash comes per se, the crash will come, and then they will find an excuse and say, well, I'm just gonna wait for the market to kind of correct itself, and I don't think this is now is a good time. So there's never going to be really, not that it's not a good excuse, but it's people, like you said, people will find a way, whether they want to buy or not, to push that and use that as an excuse. So I mean, you can't really persuade them. You can just hit them with facts. You know the saying, facts don't care about your feelings. Like,
They don't.
They don't, man.
Neither do numbers.
Neither do numbers. And I mean, right now, obviously, it's a bit of a scary environment just with all the news articles that are coming around. But as long as you do your research and you know, you do your due diligence, you can find that it's not as alarming as some of these articles really say.
Yeah, and when you're renting a place, you're essentially taking on the same responsibility as if you own the place, right?
Yeah.
Because if you don't pay your rent, you're going to be evicted.
Exactly.
Sure, you can fight it, but you're going to be evicted. If you're a homeowner and you can't pay your mortgage, you're protected by the homestead laws. It's much more difficult in the state of Florida to be kicked out of your primary residence because of the homestead laws than it is if you're a tenant and you stop paying. It was a little bit different during COVID because we had the some regulation come in where, you know, the eviction processes were halted and all that. But ultimately, in a normal market, if you don't pay your rent, you get evicted. If you don't pay your primary residence home, you got a fight on your hand. At least you can push back on the banks, and the state of Florida laws will protect you. Sure, up to an extent, but it will protect you more than if you just stop paying your rent as a tenant. So, you know, for anyone that's really on the fence about renting and they continue to find excuses, there's really nothing we can tell them that'll convince them if we just show them the numbers. Historically, real estate performs, you know, the markets go up and down, but it's a great foundation to, you know, to start a investment portfolio, et cetera, et cetera. And these people still don't want to purchase. At that point, we just have to, you know, just move on from trying to convince specific people or friends whether it makes sense for, you know, to buy or not. I think it's definitely a good decision, you know, in general for someone that can buy over renting. I think that, you know, just in recap, if you look at the effect that the inflation will have on rents, they're going to increase as time passes based on inflation. If the market drops and it takes away some of the buyers out of the market, that means you'll have more tenants. That means you have more competition in the tenant market, in the lease market, which will drive lease cost up. So you have inflation pushing up the cost of leasing. You have more competition, more tenants entering the market will also drive up the cost of leasing. So even in a market that you expect the market values to drop, once you lock in your interest rate, you're locked in at that price. It's not going to go up in the next 30 years. And even if if the interest rates aren't the best right now, you can still refinance later on. So if you're somebody that's like rate sensitive, meaning that you really want that 3% again, and the only thing available is 5-6%, you'd have to buy that 5-6% and then just refinance later. It's much cheaper to you in general than it would be if you just rent waiting for that 2% or 3% that may never come. A lot of times people forget that 2-3% was just artificially created by the government during COVID. And I told a lot of our clients, we're never going to see this again. You got to take advantage. And some still wanted to wait, wanted for prices to go down. Demand continued to drive prices up. And here we are today. We're waiting for a market crash. So I think those people that are waiting for a market crash, eventually there will be a correction. I don't know about a crash, but there will be a correction. And eventually they will be right.
Yeah. And to bounce off that as well, to your point with renters and how they're going to kind of incur the costs from landlords. I mean, we've seen it with, this year with property insurance on the rise, and maybe even property taxes kind of going up. Obviously that's a given, but however, you see that just pretty much everything, food, gasoline, common necessities in your store, whether it be toilet paper, paper towels, paper plates, everything has gone up. And a smart landlord will say, well, if this tenant is, going to stay here, he's a good tenant, but I'm just going to increase his rent a little bit, maybe a couple $100, the tenant's going to feel that. And then they're going to say, oh, but I'll just go somewhere else. But then every landlord might just start to increase rent because they're going to follow the trend. And we've seen it this year. I mean, rent has gone up insanely this year, and a lot of my friends who are currently renting have felt it. So I think it's just best to really follow the professional's advice. And I mean, it's never anything of an approach of force, but it's more along the lines of, like you said, numbers don't lie.
Yeah.
And it's statistically proven that you can save a lot of money by just purchasing your property and moving in.
And
your
if
spot.
if you're a current homeowner or an investor, right, how to prepare, just kind of to close out here, how to prepare if you think there is a correction or a market downturn or crash, whatever you want to call it. If you see it coming, I think the best way to prepare is to start using the equity available in the investment properties, either through a home equity line of credit or through a cash out refinance. Equity is one of those things that it's essentially just made up money, right? It's the value or the perceived value of your property versus the loans you have against it. That difference is your equity. So if you're not using that equity and you're expecting the market to drop, right, and